So let's get started here on Chapter 5. We have tons of ground to cover. For those of you that haven't, the slides are now available. You can print those off or not print those off. It's up to you. We're going to roll through for as long as my voice can take it. Then we might take a 5-minute break. Then we'll come back, keep going until we get through all this material this morning. So the learning objectives from Chapter 5 are, we're going to talk about what gross income is for tax purposes. We are going to describe specific inclusions and then exclusions to gross income. And so this chapter doesn't have a lot of meat to it, but I've thrown a few things in so that it makes it interesting. So let's start with something that we were going to look at really in the last module. And you can see on the left, we've got how to calculate taxable income for corporations. And the good news is for corporations, super easy. Gross income minus deductions is taxable income. And there's not a lot going on there. And when we get to the corporate chapter, you'll see there's a handful of small modifications we're going to make. Otherwise, pretty straightforward. For individuals, you can see that we have this breakout between AGI and then after AGI. And adjusted gross income is an important measure for individuals. And even though this isn't an individual course, we need to understand, at least in part, why that AGI is important. And what we're going to see is that there are a number of deductions that are dependent on your level of AGI. And so as a result, that becomes a bit of a bellwether measure of income, even though it's not taxable income, from the perspective of calculating individual taxable income. And I think what you will see is if you take 503, AGI is super important, but we'll touch on it a little bit as we work along. So Tony, I see you joined us. If you want to mute your camera, go down to the bottom left in Zoom and just hit the camera mute button. It's down there and it just turns off your camera for you. Okay, so that's about it for this, this particular schedule. So we're talking about gross income, and in case you haven't figured this out, we're turning the corner finally on tax law in this module. So the last module was a lot of policy, it was a lot of thinking, whereas now we're actually getting into the tax law. So Code Section 61, gross income means income from whatever source derived. So that's a pretty broad definition. Under the regulations to that code section includes any income realized in any form, whether money, property, or services. So income from whatever source in any form. And uniquely, there's a regulation 61-3 that says it means total sales less the cost of goods sold. So it's important to recognize that within your calculation of gross income is the opportunity to deduct your cost of goods sold. And that becomes important a little bit later when we talk about some deductions that are prohibited. Otherwise, it's just a bit of a quirk of the tax law. So taxpayers will recognize gross income when they receive an economic benefit, when they realize the income, and when no provision allows them to exclude or defer that income, which means not recognize the income. And we're going to talk about realization versus recognition in a little bit. So an economic benefit, just to make that clear, borrowed funds represent a liability. As a result, there's not an economic benefit, therefore that is not gross income. And then there's this idea of a realization principle, which is when I engage in a transaction with another party, there needs to be some measurable change in property rights, or else there's not been a realization of that transaction. And realization is a magical tax term. It means something special. Recognition means that the realized income is now recognized, and recognized basically means included in gross income and reported. So if it's almost always recognized, realized income is almost always recognized unless there's a deferral or exclusion. And exclusion means you never recognize it, and deferral means it's just recognized at some point in the future. So if Brad buys some shares of Cheesecake Factory for $34 a share in July, and then the price of the cheesecake stock has risen to $40 a share at the end of the year, does Brad have income? Well, he almost certainly has economic income, right? The value of his shares has gone from 34 to 40, but does Brad have a realization? And the answer is no. He hasn't sold those shares, and so there's been no transfer or substantial change in ownership rights. And as a result, there's no realization. And without realization under the tax rules, except in very, very limited circumstances, which are way beyond the scope of this course, without realization, recognition is generally not triggered. If, however, Brad sells the stock on the last day of the year, well, now a realization event has occurred. And barring any form of exclusion or deferral, the income or the gain is almost certainly recognized. So there's another important concept within gross income known as the return of capital principle. And we actually just went through it, but we didn't discuss it in detail. So gain from the sale or a disposition of the asset is included in realized income. Okay, I think we get that now. The cost of an asset is called its tax basis, and basis is another magic tax term. So it represents the amount that you're going to recover tax-free. And return of capital refers to the way we exclude tax basis from the realization of income. So this seems so obvious, it's so intuitive, right? That the portion of the proceeds that represent your tax basis are excluded from realized income because they don't, of course, represent an economic benefit. So we talked about Brad buying these shares for 34. The stock price rises to 40 and he sells them. The amount realized is 4,000, another magical tax term, amount realized. His adjusted basis, 3,400. That's the amount he spent. Under the return of capital concept, of course, he doesn't have to include that 3,400 in his income. As a result, his realized and thus recognized gain is $600. Without the concept of tax basis, his gain would be the amount realized. What did he actually receive? Again, it makes perfect sense, but recognize tax is a prescribed form of calculating taxable income. And as a result, we need to prescribe this actual issue known as tax basis, which again seems super intuitive. So Mark's a lawyer, and his clients make the following payments to him for services rendered. So he gets $1,000 worth of cash, he gets a check for $1,000, a credit card charge for $1,000, et cetera, et cetera, et cetera. And the question is, which of these are included in gross income? So let's start with $1,000 of cash. Pretty straightforward. That's from any source in any form. That's gross income. How about a check for $1,000? Well, a check is really no different. That's property. It's gross income. If he has a charge, not on his credit card, but someone charges their credit card to him, is that gross income? It almost certainly is. How about if he receives a gift card? Yeah, that's still gross income. What if he receives chickens, right? So whoever his customer is can't pay him, so they give him $1,000 worth of chickens. Is that gross income? Yeah, you better believe it. Even chickens are income. And if he barters for car repairs, hey, I'll do a little legal work for you if you fix my car. The market value of those repairs are $1,000. Yeah, that's right. It's gross income. But what about if one of his customers makes him a promise to pay $1,000 next month? So I don't have the money today, but I promise I'll pay you $1,000 next month. Is that gross income to him? And the answer is, it depends. And it depends on the accounting method Mark is going to use. And we're going to cover that when we get to Chapter 9. Okay, so there's another rule about the recovery of amounts previously deducted. This is known as the tax benefit rule. So typically, expenditures are deducted in the year paid. That's pretty typical. But every once in a while, something you deducted may be reimbursed or refunded in a subsequent year. The tax benefit rule says that when taxpayers receive a refund of something they deducted in a prior year, they're required to include the amount in gross income to the extent that deduction actually reduced their taxes in the year of the deduction. Okay, so Aloha Inc. is an accrual-based taxpayer. And they have accounts receivable that become worthless. right? So hopefully you recall at least some of your accounting allowance for bad debts sort of thing. So Aloha deducts bad debt expense for the write-off in year one. And for tax purposes, there's no such thing as an allowance for bad debts. You can only write it off when it becomes worthless. So that has in fact happened. And so Aloha deducts the bad debt expense in year one. In year two, for whatever reason, the customer wins a lawsuit and comes into a bunch of money. And, wanting to maintain decent relationships with their suppliers, they pay off the old accounts receivable to Aloha. So, of course, it makes sense that under the tax benefit rule, Aloha needs to recognize income under the tax benefit rule because they had a deduction, they had the benefit of that deduction, and now they have to add it back to income. So All American Burger is a cash basis taxpayer. So All American Burger has an accounts receivable that becomes worthless as well. But All American Burger does not deduct bad debt because they're a cash basis taxpayer. As a result, they do not recognize accounts receivable as income. In year two, the customer wins the lawsuit. They pay off the old AR to All American Burger. All American Burger also needs to recognize income because they never recognized the deduction to begin with. Okay, so one last interesting twist on this issue, and it really just gets woven into this, but it's not really necessarily the tax benefit rule. So Stacy wishes to purchase a car for $20,000, and the dealer's offering a manufacturer's rebate of $1,000 if she buys today. So she goes ahead and she purchases the car for $20,000. And then in the following month, or maybe 2 months later, however long it takes, she gets a rebate check from the manufacturer. And I think the question is, does that $1,000 rebate check represent income? And of course, when you think about it intuitively, it does not. She doesn't have $20,000 of expense and $1,000 of income. She really just has $19,000 of expense. And maybe that's deductible, maybe it's not. It depends on whether it's personal or business use. Okay. So this one gets a little bit outside of the scope of this course because the classic case of the tax benefit rule is related to a state income tax deduction that's totally related to individuals. It could happen to a corporation, but it's far less likely. But because it's the classic case, we're going to cover it in this course. And if you've taken 503 or you're going to take 503, you'll almost certainly cover it again. But a little redundancy never hurt anybody. So in order to understand this, we need to have a little bit of understanding about how the state income tax deduction works. So first, state income taxes are deductible by individuals that choose to itemize deductions as opposed to taking the standard deduction. And the amount paid during the year is deductible. Now, under 2018 law, that's now limited to $10,000, but that's neither here nor there. So Damone is a wage earner. He has $900 of California state income tax withheld from his paycheck in 2017. So you can think of that as he's paid $900 of state income taxes. Damone itemizes deductions in 2017. And the total amount is well in excess of the standard deduction in 2017, which was $6,350. So the $11,000 of his itemized deductions includes his $900 of state income taxes paid. In 2018, when he files his California state income tax return, he determines he's going to do a refund of $50, noting that the individual income tax system is a truing up system when you file, right? It's really just matching what you've paid in versus what your actual tax liability is. To the extent you owe, you make an additional payment. To the extent you've over withheld, you get some of that back. In May 2018, California issues Damone his state income tax refund of $50. So because Damone enjoyed the benefit of that $900 deduction in the prior year, he must now include the $50 refund in income, and that follows squarely within the tax benefit rule. Pretty simple and straightforward. So let's move to 2018, where he's a wage earner, and clearly got a big raise because now he's had $9,000 withheld from his paycheck in 2018. He itemizes again. Total amount is in excess of the $12,000 deduction, and $11,000 of that is his state income taxes paid. In April 19, Damone files his California state income tax return, determines he's going to get a refund of $50. Because he enjoyed the benefit of the $9,000 deduction, he must now include the $50 in income. Okay, let's redo this, except assume that he takes the standard deduction. So if he takes the standard deduction, then none of that $9,000 is included, or it's not deemed to be included in his $12,000 standard deduction. So even though he gets a refund, he did not enjoy the benefit of the $9,000 deduction. As a result, he doesn't include the $50 refund in his income. Okay. So once we've decided that just about everything under the sun is gross income, the next question we have to answer is, when do we report income? So individual taxpayers file tax returns for a calendar year period. There are very extreme, unique situations where an individual might file on something besides a calendar year, but 99.99% of all individuals file on a calendar year. Corporations, on the other hand, can use a fiscal year, as we know from calculating when their due dates are in the last module. But in either case, the taxpayer's method of accounting generally determines the calendar year in which realized income is recognized and income is included in gross income. So the typical accounting methods for a corporation, they used to at least almost always use the accrual method of accounting. And when we get to accounting methods in Chapter 9 in this lecture, we'll see that they've really relaxed the rule about how many corporations have to use the accrual method. But in any event, many do. And almost all individuals use the cash method of accounting. And again, we'll break those down a little bit further when we get into Chapter 9. One of the unique things under when you must recognize under the cash method is that a taxpayer must realize and recognize income when it is actually received. Okay, I understand what actually received is, or when it is constructively received. So what is constructive receipt? So constructive receipt does not actually require the money to fall into the possession of the taxpayer. It's constructively received when it's credited to the account, set apart, otherwise made available so that the taxpayer could draw upon it at any time, or could have drawn upon it if notice of intention to do so had been given. But it's not constructively received if the taxpayer's control of the receipt is subject to a substantial limitation or restriction. So Dina is a cash method taxpayer, and she receives a check for services provided in the mail in December of year one. So the services were provided in December of year one. So is it income in year one if she waits to deposit the check until year two? And the answer is, yeah, it's still income, right? She's received it. She's in control of it. There's no substantial limitation on it. She's in constructive receipt of that income. What if she doesn't even open the envelope? Not relevant. In fact, it doesn't even matter if she doesn't know there's a check in that envelope. She's in control of that envelope. As a result, that's constructive receipt to her. What if she refuses to check the mail? So she's like, I'm not going to check the mail because I don't want to include any of the income I receive at the end of the year in income. Same problem. Under the constructive receipt rule, you simply can't turn your back on the income. You just can't do it. So what if the mail comes after her bank is already closed for the day? So in this case, she has the check, but she certainly can't put it in her bank account. Guess what? Totally not relevant for constructive receipt. She's in control of that property. She could negotiate it elsewhere. She could go to a check cashing place. She could sell it. There's all sorts of, she could endorse it over to someone else. The reality is she's in constructive receipt of that income. So what if the check was supposed to be for $1,000, but was accidentally written for $100? And then once notifying the customer, she received the rest of it in year two after the mistake was discovered. Well, this is almost certainly not constructive receipt for the $900. So I probably would depend on the level of the mistake. So as you know, if you've written a check before, there's two boxes. There's one for the numerical amount and one for the written amount. And the rule technically is whatever's written is the guiding one. So if they wrote $1,000, 1,000, wrote it out completely, but actually then just wrote 100.00 in the numerical box, I'd probably argue they're going to try to cash that check for $1,000. But if on the other hand, it was truly written out for $100, clearly she's not in control of the other 900. She owns no property. She's in possession of no property that would give her that 900. There's no constructive receipt. So what if the check was post-dated? So occasionally you get a check from someone and they're like, hey, I post-dated it January 10th of year 2. Well, a business could receive hundreds of checks a day. And many of them probably aren't even going to be checked to see whether or not that check was post-dated or not. If it just goes into the batch of other checks and gets cashed, pretty sure there's constructive receipt there. So what I would say is that if the check was post-dated and the taxpayer had some knowledge that the check would bounce, that there was insufficient funds to cover that check, well, now that's a substantial restriction on the control of that money. And as a result, if it was post-dated because there are insufficient funds, no constructive receipt, no income. On the other hand, even if it's post-dated, it probably just gets cashed because the banks don't really look that closely. Therefore, constructive receipt, income. Okay. So the claim of right doctrine is just this little tweak in the tax code, and it's kind of out there because the tax law is built, think of it, to maximize revenue, right? It's not about whether or not it makes good sense from an accounting or a matching principle perspective. And the claim of right doctrine is one that was developed by the courts and has been certainly absorbed by the IRS, adopted by the IRS, because it makes sense for them. So basically it means that you have income in the period of receipt, even if there's potential for repayment. And that potential requires either some future event to occur or that there's no restriction on it. So Mr. Hand is a school teacher, and he embezzled the field trip money that the students had given him during the year. So under the claim of right doctrine, even though if he's caught, clearly Mr. Hand might have to repay those embezzled funds. Excuse me while I take a drink, I'm losing my voice. In the period of embezzlement, he had unfettered control of the funds. And until that embezzlement is discovered, the tax benefit rule says, no way, dude, or sorry, the claim of right rule says that's income to Mr. Hand. The tax benefit rule would say, okay, well, when you get caught and you have to pay it back, now we'll allow you to deduct those reparations when you pay them. So the claim of right is really just an aggressive income recognition stance that's been built up between the courts and the IRS. Okay, so in addition to determining when taxpayers realize and recognize income, it of course is also important to consider who recognizes the income. And we definitely covered that in the last module. And given how much we have to cover today, I don't want to spend a lot more time on it. But of course, the assignment of income doctrine prevents us from just shifting income willy-nilly. Okay, but what about when we have something besides earning income through wages? Something like the sale of property. So let's go back to Brad and his stock. We know that the amount realized that he received for the sale of the stock. Let's go ahead and define that, and we'll define it more later. The amount realized is any cash plus the fair market value of any property you receive minus any selling expenses, and as you'll discover later, plus any net liabilities relief. That's the amount realized. His adjusted basis was his cost, and later on we'll discover that we're going to adjust that basis for depreciation and amortization. So when we have a sale of property, we have a realization event. When we have a realization event, this is a critical chart that we would need to learn. And when I post this video, there's going to be a blurb right now that says, learn it, live it, know it, because this is a fundamental part of calculating taxable income is realization event drives an amount realized minus adjusted basis calculation. Okay. So other types of income that we might see, and we cover these in dribs and drabs until we get to these chapters, but you might have income from flow-through entities. So for example, if you're an investor in a partnership or an LLC or an S-Corp, those are all flow-through entities. And the income flows through from those entities, whether it's actually distributed to the taxpayer in cash or not. And as a result, when it is paid in cash, it's generally excludable because you don't have to double count that income. And we're going to talk about something in terms of calculating the tax basis on flow-through entities. And when income is included, the tax basis in those investments goes up. And when losses are passed through, the basis goes down. And we're going to cover this extensively as we move through. Hi, Olivia. How are you? So prizes and awards. So prizes and awards are income, right? So if you go on a game show and you go on a Price is Right and you win a new car, yeah, guess what? That's income to you. If you go on Oprah and she gives away a car to everyone in the audience, that's a prize. And yeah, that's income to you, and you're going to have to pay income tax on that. But there are 3 exceptions to this rule. One is if you receive a scientific prize, there are no future services tied to that, and you direct the payment directly to charity. So it doesn't even flow through you. You just tell whoever's granting you that award that you want it paid directly to charity. Those are clearly, that exception is clearly written for the Nobel Prize. There are length of service awards that are payable to employees. So if you work at a company for 5 years, then 10 years, 15, 20, 25 years, often employers will give a small token or gift to their employees. And those are considered length of service awards. They can also be done under a safety award program. So you can give someone up to $400 of non-cash property per year based on a length of service award. It must be non-discriminatory, which means it can't only be for high paid income people, and it could be based on a safety program. So if you develop an actual qualified plan, you can actually give away up to $1,600, again, not cash, and the individual receives it does not have to include it in their income. So, and then a couple years ago, they passed a tax law that said for Olympic athletes, if you get an Olympic prize, the U.S. Olympic Committee gives away, I think it's $25,000 now for a gold medal. You do not have to include that in your income as long as a taxpayer, you make less than $1 million. So there was a moderate change to these rules with the Tax Cuts and Jobs Act of 2017, so the latest Trump Tax Act. And all it really did was expand the definition of non-cash. So the courts had long since decided that gift cards were cash, that gift certificates were cash. But what happened is they included that in the statute now. So pretty much what happens is if an employer pays an employee cash for just about anything, and we'll exclude fringe benefits, non-taxable fringe benefits when we get there, for the most part, that's taxable. Okay, so Jeff is the sole owner of Spicoli Corp, and Jeff needs a loan to pay for his kid's college. So the Student Loan Association offers him $50,000 at 4.5%. I don't know why Jeff needs $50,000. He must be going to USD, way more expensive. But instead, Jeff says, wow, 4.5%. Well, since I'm the sole owner of Spicoli Corp, why don't you just have my corporation loan me $50,000? And since I'm in charge, why not make it at 0%? And so the question is Jeff better off, right? Has he received some form of economic income because he got a 0% loan when market rates were 4.5%? And the tax code calls that imputed income, which means you've received some indirect economic benefit, and the amount of that indirect economic benefit, you better believe, is gross income from whatever source in whatever form. So, for example, certain employee discounts or low interest loans can generate income, like the one between Jeff and his company. The amount of imputed income is the difference between the amount of the loan multiplied by the applicable federal interest rate and the amount of interest that the taxpayer actually pays. So in order to deal with loans between related parties like this, because it should come as no surprise that loans between a wholly owned corporation and its owner occur all the time in both directions. Sometimes the shareholder loans to the corporation, sometimes the corporation loans to the shareholder. The IRS actually publishes an interest rate every month. And if your interest rate on your loan is below that amount, then you have imputed interest. So the imputed interest rules do not apply to loans of $10,000 or less. So if you have a small loan to a family member or something like that, it doesn't apply to those. So 5 years down the road, Spicoli Corp just out and out forgives Jeff loan. Now remember, Jeff's the sole owner of Spicoli Corp. So it's pretty simple for him to have the corporation forgive his loan. Is Jeff better off? Well, yeah, you better believe it, right? If someone forgives your debt, you're definitely better off. And discharge of indebtedness or forgiveness of debt represents gross income. And the only way that wouldn't be true is if Jeff is insolvent. So if Jeff's liabilities exceed his assets, there is a loophole that allows just discharge of indebtedness not to be gross income, which is really within that ability to pay model, right? So if you're insolvent and someone forgives your debt, you really still don't have the money to pay that off, right? You certainly couldn't pay the taxes. So as a result, insolvency is a nice tax policy position on including discharge of indebtedness in your gross income. Okay, so this is just a giant list of things that are includable in gross income. You certainly should not think about sitting down and memorizing a list like this, especially given this is a totally online class and you would have it in front of you at any time if you wanted it. But that is the laundry list of everything included in gross income. And of course, the tax law says, and basically anything we didn't put on the list is also included in gross income, in case we forgot something. Okay, so recall that exclusion means never taxed and deferral means taxed later. So our first exclusion we've already dealt with, municipal bond interest. So bonds issued by local and state governments in the United States are tax exempt. They are excluded from gross income. Interestingly enough, interest on U.S. government bonds, so U.S. Treasury bonds, T-bills, that's entirely taxable. Now, there are some loopholes for U.S. savings bonds if they're used for the right purposes, but that's all within the individual framework, and we're not even going to go there. All right, so that brings us to fringe benefits, and we're gonna double down on fringe benefits in this module because we're going to cover it twice. We're going to cover it once briefly in this section, and then again when we get to chapter 12. So if I make a payment to an employee of something other than cash, the potential is for it to be a fringe benefit. Generally speaking, whatever the value of that is included in the employee's income as compensation for services. And this is a really difficult hurdle to overcome. So let's say I run a sales promotion for my salespeople, and whoever meets quota, they get a free trip to Hawaii. The value of that trip to Hawaii is included in compensation. And that's almost always true, unless there are certain fringe benefits that we call qualifying fringe benefits that we actually get to exclude from gross income. And common qualifying fringe benefits are your employer can pay for medical and dental health coverage for employees, and the amount they pay is not includable in your gross income. They can pay for some amount of life insurance for an employee, and the premium that they pay on your behalf, not included in your gross income. And then there are other de minimis small benefits that they can cover that are also not included in your gross income. So again, the common ones: employee provided health and dental insurance, life insurance up to $50,000, de minimis costs, meals and lodging at the employer's convenience, and we're going to talk about how that's changed a little bit, but not from an exclusion perspective. No additional cost services. So that's if you work for the airline and there's an open seat on the plane, the airlines let their employees fly in that seat for free. That's a no additional cost service. It doesn't cost the airline any more to put that employee's butt in one of those open seats. An employee discount up to a certain amount is excludable. So if it's goods and services, it's up to the profit. If it's goods, it's up to the profit. If it's services, I think it's 20% of a discount, and it can just be excluded. So if you work at, I don't know, Macy's during the holidays to make a little extra money, and you also get the discount on the things you purchase there, as long as you buy it and the amount that Macy's sells it to you is greater than their cost, you don't have to include that discount in your income. So working condition fringes. Hold on one second, you guys. What? Sorry, my son's home. He should have caught the bus. It was late start today. Hopefully he's not late. So working condition fringes, we'll talk about those later. There's an exhibit in your book that lists all of these, and that's worth a go through, although we're more concerned with the employer's perspective than the employer's perspective than the employee's perspective. So again, the biggies: medical and dental life insurance coverage. The employer gets to deduct that cost, but the employees do not have to include it in gross income. Meals and lodging at the convenience of the employer. So if you work somewhere like Google or Facebook, and they have a company cafeteria, that's provided on the business premises and for the employer's convenience, then the employer deducts it and the employee doesn't include the value of that, whatever the subsidization is for the meals, in their income. However, starting with 2018, that deduction is reduced to 50%, and then in 2025, it goes to 0%. So think of that as they're not eliminating the exclusion from the employee's income. Rather, they're eliminating the deduction on the part of the employer, which will make that basically a non-qualified fringe benefit. So moving expenses used to be a fringe benefit. This is if your employer moved you, they used to be able to pay the cost to move the employee. Starting in 2018, moving expenses are no longer excludable from income unless you're being moved as a function of your working for the U.S. Armed Services. So if you're redeployed somewhere and you have to move, of course, the Army, Navy, Air Force, Marines pays for that move. You do not have to include that in your income. For the rest of us, we have to include it in our income. Okay, so others. Gifts are not taxable to the recipient. We talked about this a little bit in the first module. If you receive a gift, that's not taxable to you. So if Bill Gates gives a $40,000 card to a homeless person, assuming that there's a detached and disinterested generosity, which is what's required to define it as a gift, there's no tax on the homeless guy, right? This is unlike if he won a prize or an award, right? That would be taxable, but a flat out gift is non-taxable. And so what you end up with is this very bizarre crosshatch of, can an employer ever give an employee a gift? And aside from that $400, $1,600 exception we talked about, the basic answer is no. So if you read the tax code, the hurdle that you have to get over to provide a gift to someone that works for you is it's unachievably high and just simply can't happen. All right, so we're coming to the end of Chapter 5, and this is a list of items that are excluded from income under the definition of gross income. So again, I'm not going to make you memorize this. There's a handful of things on here, but that basically brings us to the end of Chapter 5.